Russell, it looked like you might have been in the office there. Are you at home?
No, I'm at home.
Okay. Thought I saw a glimpse of kindred back there.
It's actually quite similar now you mention it, but no, it's my house.
Guys, we're streaming live now.
Okay.
Good afternoon. I think we'll make a start. Welcome everyone to the I'm a Founder webinar. My name's Adam Brody. I'm the co-founder of Ignition Financial. I'm delighted today that I'm joined by Jason Foster, who is an angel investor, and he is also a non-executive director in a number of businesses which he has invested in, as well as being the CEO of biotech startup Ori Biotech. I'm also pleased that we've got joining us Russell Buckley, who is a partner at Kindred Capital, and Amit Mendota, who is a partner at Mobius Equity Partners. So we've got three different investors here covering, I would say, seed, Jason and Russell, and Series A, B, which would probably be more in the Mobius territory, but I'll let the panelists introduce themselves shortly. The format for today is the speak panel will introduce themselves. We're going to have some brief discussions on a few of the topics which you can see there on the screen. and then we will open the floor up to questions. And I know the panelists are really keen to take your questions, because I know, well, certainly myself and some of my colleagues, asking what's on venture capitalists and angel investors' minds is a question we are being asked a lot at the moment. A little bit of housekeeping. If you do have a question, please could I ask you to type it into the Q&A box, and it would be really, really helpful if you could address it to either Russell, Amit, or Jason, or leave it open if you are happy for any of the three to answer, but ideally it could be addressed to one of them. That'd be great. Stu, please could you put up the poll? So we've got 3 questions in our polls here, which it would be great if as many of you could answer as possible. The first question is, how do investment discussions feel compared to 3 months ago? I would imagine, well, actually, I won't influence it. Let's see what the results are there. The second one is, when are you likely to need an investment round in the future, if at all? And then the third one is, how do you expect valuations to change? And on the third one, we have some research from venture capitalists, I think predominantly from the US, but will be interesting to compare and contrast. Okay, right. Let's get going. Jason, perhaps I could ask you first of all to introduce yourself.
Sure. Thanks, Adam. Hi, I'm Jason Foster. I am my day job is the CEO of Ori Biotech, which is a cell and gene therapy manufacturing technology company. So helping to enable a new generation of personalized medicines to reach patients. I also am an angel investor and sit on the board of several companies in the healthcare and health tech space.
Thank you, Jason. Russell? Sure. I'm Russell Buckley from Kindred Capital. We're a seed stage £80 million fund based in London, although we invest throughout Europe. I guess what's different about us as a team of 4 partners is we've all got extensive operational experience ourselves, which we think is a really important asset in early stage investing, not so much later stage, because then it becomes more of a financial transaction. But we believe that having operational experience and having walked a mile in the entrepreneur's shoes, as we like to say, we understand what it's like and we can help. Just to give you an example, my background is I was part of the founding team of a company called AdMob, which was started in 2006, sold it to Google in 2010 for 750 million for their 3rd biggest acquisition. I guess the other thing which is different about Kindred is we invented something which we like to call equitable investing, and what that is that we share the carry or the profit in the fund with the founders we invest in. Why would we do that? Well, we found that on our entrepreneurial journeys, it was very often other founders who were as helpful, if not more helpful, on the journey than some of our investors. And therefore, we decided to put an economic incentive to encourage them to help each other and support each other. In Fund 1, we reckon that amount of money is going to be about £5 million, which would otherwise have come to the partners, me. So when we launched Fund 2, we decided to carry on. So we really must believe that it worked well in Fund 1. Otherwise, why would we throw away £5 million? We just started Fund 2, have 5 investments so far. So still looking for lots to invest in, and excited to be here. So thank you very much for inviting me.
Thanks, Russell. And is there a sector focus for Kindred at all? Or
no, we're not sector focused. We do everything from deep tech like 5AI. We invested in Jason's company, which is pretty complicated stuff. And at the other end of the spectrum, we invest in a consumer product like Fairwill, which is an online will writing company, which, as you can imagine, is doing incredibly well right now.
Yeah.
With everybody sort of suddenly focused on mortality and everything, and getting their houses in order. They're the unlikely and slightly unwilling beneficiaries of that. But at the end of the day, everybody needs a will, should get a will. So if there's an upside to the COVID-19 virus, it's that a lot more people are getting more structured and organized, as they perhaps should be anyway.
That's quite important, and I've just got something to put on my to-do list as well. Amit, maybe you could say a few words about yourself and Mobius, please.
Sure, thanks, Adam. Good afternoon, everyone. My name is Amit Mendota. I'm an investor at Mobius Equity Partners. We manage a circa £300 million VCT fund, and that is investing Series A and beyond. So our equity checks are between £2 to £20 million, and typically backing businesses that have reached the stage where they're at £1 million revenue plus. So the first institutional round that businesses are looking to do.
Thank you, Amit. So on our panel today, we've got the decision makers, those that sit on the investment committee. I imagine Jason's investment committee is quite a good meeting, actually, just him. So so I thought we'd kick off by Stu, if we could go on to the next slide, by looking at some of the investor priorities. And just to prompt, I know there's been some research which some of you may have seen, is how venture capitalists have been spending their time. So you can see the big shift here is working with portfolio companies. That has increased quite significantly, and evaluating new deals. There seems to be a bit of a switch there. Does that correlate with your experiences? Amit, maybe if we start with you.
Yeah, I think that graphic is very accurate. We, in the immediate aftermath of the UK going into lockdown, we effectively pivoted our investment team into focusing pretty much exclusively for the first few weeks just on preserving and protecting portfolio value and supporting those businesses in a much more hands-on way than we usually would. So filling in the gaps where businesses didn't have the capacity to fill in their CBILS applications and things like that. I think there's naturally an easing of that as the businesses have now got a handle on things, and we are, much more now looking at new deals. But certainly over the past month, that is very, very accurate of how things have been in our business.
Thank you, Amit. Russell, perhaps we could hear from you on this matter. Where have your time and priorities been?
We tend to be quite hands with our companies anyway. I mean, I spend at least half an hour to an hour every week with all my portfolio. So there wasn't an awful lot of necessity to get up to speed or have board meetings and stuff like that. We think it's important that in the early stage of a company, again, that you get that hands-on support. Not in a kind of directorial way, but more in terms of, just being there to bounce problems off us and stuff like that. At the end of the day, the CEO is always going to know much more about their business than we're ever going to do. But it's more about being there as a sounding board and general advice. And yeah, there was a couple of weeks when we were helping our companies think about the future. But actually, in reality, they were all really, really good at grasping the nettle and making the tough decisions. And a lot of the time it was more a question of us saying, yeah, that sounds like a reasonable plan, rather than saying the world's on fire, you've got to start, winding people down and everything.
Yeah.
So there was a moment when we were a bit more focused on internal, but generally speaking, we were keeping up external new meetings and everything all the way through this. And one of the first things I did as soon as we entered our lockdown process, which was on the 10th of March, actually, which was much earlier than government advice, we did make a point of putting up on a blog post on Medium that we're open for business. It'll just be virtual for the time being, and we're still keen to see companies and still keen to invest. I think it's also worth saying that we had 3 companies in term sheet at the beginning of this crisis, and unlike some of the bad behavior I've been hearing, we didn't try and take advantage of the crisis, and we just closed at the valuation in the way we anticipated. And they're all now happy members of our portfolio. At least I hope they're happy, but they're in our portfolio now, and the deal's closed on time.
Oh, great. So you've closed 3 investments since the lockdown.
Yeah, we were already in term sheet before the lockdown, but they proceeded as planned. Yeah, as I say, they're all part of the portfolio now. So we're very pleased to have them on board.
Well, that's great to hear. Thanks, Russell. Jason, you've invested in a number of businesses in the healthcare and health tech space. But you're also full-time at Ori Biotech, so I imagine you've been pretty busy.
Well, it gives me a bit more empathy, I think, with founders sitting on both sides of the table, certainly, and a bit of insight as to kind of where the market is. We are in the fortunate or unfortunate position to have kicked off a Series A round for Ori in January, so at the JP Morgan Healthcare Conference in San Francisco. And fundraising is hard and it's slow at the best of times. We've had a tremendous amount of interest and support of Kindred and Amadeus and some of our other investors as well has been hugely helpful. And we hope to be reaching term sheet stage in the next week or two with a couple lead investors from the US-based VC fund. So I think it's happening, but in response to the I wasn't allowed to answer the poll question, but I think it certainly has slowed. I noticed that you didn't have on there, it's gotten easier. It certainly hasn't gotten easier in the last 3 months, but there's capital out there, there's liquidity out there, there's funds that want to invest. I think the hardest thing is not being able to get face to face with people. It's if you're going to give someone in the Series A round, we're looking at 5 million checks ish, 3 to 5 million maybe. You're going to give someone 3 to 5 million quid if you haven't had a chance to sit across the table from them and stare them in the eye. It becomes harder. On the investor side, I've been relatively active. I closed an investment last month and have 2 that are about to close this month. So, definitely deals still happening.
Okay, that's great. And the deals that you invested in, Jason, were they with your existing portfolio or were they new companies?
Those are new investments.
Oh, great. Okay. Amit, as a VCT, I would imagine there's perhaps been a little bit more of a slowdown in the new deal front with Mobius, but is that true, and is that changing?
Yeah, I think that is true. We've closed an investment as one of our portfolio companies earlier this week, a follow-on investment, and we're due to close another one next week. So those are businesses that are actually benefiting from this environment, and we're providing them with further capital to allow them to take advantage of that. On the new deals front, I think Jason made an interesting point. It is very difficult to put several millions of pounds into a business where you've never actually met someone.
Yeah.
You never sat there face to face, broken bread with them, had a beer with them. So we are continuing conversations and progressing diligence on businesses where we had already met businesses and that we were in process with. So we expect to close some of those over the next few months. We are obviously looking at new businesses, but I do personally feel it'll be quite difficult to transact on those where you haven't met the management team, the principals in person. But given the indications are that we should be seeing some easing of the lockdown later in the next week or so, it's not beyond the realms of possibility that we would be in a position to be meeting these people in the next month or so, which would obviously make those decisions a lot easier. So yeah, I expect us to be making several portfolio and new investments over the next quarter, but it's undoubtedly at a slower rate than it has been in the previous quarters, as there's been a hiatus of a month or so in normal proceedings.
That makes a lot of sense to me. I remember in my days working in M&A on a deal in China, we were struggling to get information through the virtual data room, and in the end, our client was a German-owned conglomerate, and they decided that we do the due diligence face-to-face. So we took a bus of 40 people to this company, and the Germans and the Chinese sat and they grilled them and looked them in the eye face-to-face, watching for body language changes and eyes shifting away. And I think that I can well understand that for big ticket checks, it is still about getting to know the individuals and looking them in the whites of their eye. Stu, perhaps we could just move on to the next slide. I guess we've covered this to an extent, but what we're really seeing here from this research from CB Insights is that deal volumes have come down in Q1, which is perhaps unexpected. The next graphic over is slightly more interesting, I think. This shows that what happened after the global financial crisis in 2008 to valuations. They all did, the funding size, not valuation. They did all drop quite significantly in the first 12 months, and then they picked up and rebounded. Is that something that you expect? Are you expecting to see less deals completed and lower round sizes, or is that not something that you expect, both in the market and in your own investment terms? And Jason, why don't we come to you first?
Sure. Yeah, I think that my expectation is that, you know, if you wanted that extra 5 million for a bit of cushion, a bit more runway, it's not really available, or as available as it used to be. You sort of have to justify every pound and every pence. So it makes perfect sense to me that, you know, we'll be raising less money. You know, our target dropped by about 25% for the Series A round because of just this phenomenon where, you know, capital's less available, people are doing less deals. And they're all interlinked, right? You know, I can't fly to the US and you know, go to Sand Hill Road and knock on doors and have those meetings. So the investor conversations that we're progressing are the ones that we met face to face at JP Morgan. We knew them before. There's some personal link, you know, as good as, you know, Zoom and these other platforms are. You know, there's a premium placed on the ability to sit across the table from somebody, and I don't think that changes. You know, certainly not as you get more mature as a company and you're in the later rounds.
Thanks, Jason. Russell, do you have any thoughts on here?
Yeah, I mean, obviously, you know, I echo the difficulty of doing remote deals. I mean, before COVID, if a founder suggested to me that we have the first meeting as a video call, I would say, well, that we can, but you have to realize that you're putting yourself at about a 50% disadvantage than face-to-face. So that hasn't changed. But then on the other hand, everybody's in the same boat. So it's a level playing field. In terms of round size, at seed stage only, I don't think that changes very much. Ultimately, the right number is how much you need to get through the next 18 months. 12 months to prove something, and 6 months buffer to raise the next round. So actually, if I tried to negotiate a smaller round size as such, what I'm actually doing is endangering the company and my money. So there's no advantage to that. I think 18 months is the right runway, and always has been, always will be. So that's the driver for me. But obviously we make sure that people are running lean as always. You know, and the caveat is that you know, there is such a thing as raising too much money. It can give you a sense of complacency, a lack of focus, and as my colleague likes to say, we have never seen any companies dying from starvation, but we do see them dying all the time of indigestion.
That's quite a good soundbite or takeaway, I think. Amit, presumably round sizes you might expect to be the same size, or is that not fair?
Yeah, it's an interesting question. I think that there's a balance here between if you naturally say, well, yeah, our entry checks are £2 million, and they're that size because Series A businesses have reached a stage where that's the quantum of capital they require, and managing a £300 million fund, when we're not in the business of writing checks smaller than that, it becomes quite inefficient for us as a business. So I think that there's a desire on our side to keep it at that level. There's obviously a desire on businesses that are coming out to raise that amount of money because they're going through a series of fundraisers. I think where you might see things changing is people coming out for slightly larger rounds where investors may say, look, we're willing to commit to that, but we may tranche the investment, or if you're looking for 10, people may be more inclined to put in 5. So I expect that graph you've put up will probably reflect now in the same way. But I don't necessarily think it'll be such a sharp decline just because of the economics of how various funds work and the need for those businesses. Putting in £500,000 doesn't necessarily give them long enough to prove what they need to, and just becomes quite inefficient all round. Okay,
so it sounds like there's an element of confidence, or maybe that the funding round size that happened up post the global financial crisis may not be as stark this time around. So I think that's quite encouraging, should we say. Stu, perhaps we could move on to the next slide. Valuations. I know this is going to be a hot topic and pretty popular with our clients. Perhaps we could flash up the poll results here. Okay, so most people, I think this perhaps correlates with what the panel have been saying, that it is going to be more difficult doing a round, but most people aren't finding it much more difficult, and good to see that there's some people who are not noticing too much of a change. And there's a variety of investment rounds, including some which will be required in the next 3 months. So I'd imagine that the future fund, which is the next slide, is going to be of interest for some of those members. The poll at the bottom: how do you expect valuations to change? We've had one response saying they're expecting valuations to increase by 0 to 30%, but by far the largest group is decrease of 0 to 30%, and that seems to correlate with the research that we have here, which is perhaps understandably venture capitalists. They're on the other side of the negotiation table when it comes to valuation. Many of them are expecting quite significant decreases, so 20% and 30%, and some a significant group of people thinking 50%. I'm not going to put you on the spot and ask for percentages, but directionally, where do you think valuations may end up, or is this more general terms of investment discussion with around things like preferential rights and other protections? Russell, perhaps we could start with you.
Yeah, I mean, I think the first point I'd make is that great companies will always get funded, irrespective of COVID-19, the 2008 crash, et cetera, there are still companies getting funded all the way through those, and some of them are really, really big. You know, in the last financial crisis, you know, WhatsApp was founded, Instagram was founded, Uber was founded, et cetera. And those companies will always be hotly disputed and competed for by the venture capital community, which means that valuations aren't going to really be affected. They may even rise, you know, who knows, as deals get done. But the most important thing for an entrepreneur to know that the reason why deals close in the first place is because there's competitive tension in the round. Yeah. And if there isn't competitive tension, you know, you might just get an awful lot of meetings where they're saying, yeah, this is interesting, come back and talk to us when you've got more traction, that line, which VCs like to use. Yeah. In terms of valuations, I mean, the one thing I would say is that we always have to help the entrepreneur think through what the next round valuation is going to be, and what the next round will look like, the proposition in terms of traction to the venture capital community who's going to invest after us. And we do that in good times and bad times as well. So we do that before we close the round, because it's really important that we get this round valuation right. Because, well, to give you an example, without naming them in my own portfolio, there was a company which we talked to about 18 months ago, and they had a term sheet for a 10 million valuation pre-money. And actually we sat down with them and talked to them and explained that that was the wrong valuation for them, and that the right valuation was a £4.5 million valuation, because we felt in 18 months time they'll be worth about 10 million at that point. If they hadn't taken our advice and gone for the 10 million, they'd be now staring at the wrong end of a gun, because they would have to have a flat, or indeed maybe even a down round. And that wasn't driven by COVID-19 particularly. It was just what we thought the right number was. But they were mature and long, thinking in the long term rather than the short term, enough to go with a valuation which was actually half what they had a term sheet for, which was amazing for them, and also the right decision for them as well as us. So, you know, valuation is always a bit of an inexact science. We don't know what the longer term effects of COVID-19 are, but I would say they would be in the range of flat to down about 20%. But at these times, you find out the real difference between very good companies and great companies, and it's the great companies which are going to get the uptake in valuation always.
Thank you. Amit, what have you been, what are you seeing, or what are you expecting on this point? Because I know valuations with at Series A have some heated discussions at times.
Yeah, I think the graphic that you put up to the right is probably, if I was to make a best guess today, 30 to 40% down seems like a sensible guesstimate from the from this data. If you look at where listed equity markets are, they're down a similar percentage, and that's an often a way that you're looking to benchmark prices, you know, with comparables. The buyers are now, who, you know, included on those listed entities, are trading at much lower prices. So your exit pricing is down. By definition, therefore, your entry pricing is going to have to adjust in order for you to make a return that stacks up. The businesses themselves are in a much more challenging trading environment. We don't know how that will fully play out, but I don't think it's unfair to say it is a much more difficult environment. As we sit here today, we have 40 companies in our portfolio. You know, obviously one or two have benefited, but by and large, most are having to box quite clever. This is, you know, not a scenario they had planned for, and it is pretty unprecedented. And I think you've got to overlay on top of this as well. Your graphic to the left shows a very healthy upturn trend over the last few years in pricing. There's a feeling across the market that pricing was pretty toppy, and investors were starting to feel quite uncomfortable at the prices they were being asked to participate in. You know, just applying very simple mechanics of saying, well, if I invest at this price, what price does this business need to sell at for me to make 2, 3, 4 times money? And they were starting to feel like very significant numbers. You know, we've been around for 20 years, and there aren't that many businesses we've been involved in that have sold for, you know, north of 50 million quid. And these casual exit numbers, 50, 100, are banded around quite a lot. So I think when you put all of those factors together, it does feel like there will be a marked correction. I would, on the offset of that, you know, investors are always happy to reward people on the upside. So I suspect you will see some lower headline entry pricing mitigated by mechanics, you know, be it growth shares, hurdle shares, ratchets, things like that, that will reward teams deliver over and above the expectation, so that the upside is shared. But I think investors will be looking to find a new appropriate level of entry pricing that'll be different to what we've seen in the preceding 12, 18 months running up to this.
Okay. I'm quite keen to get to some questions from the attendees. So if you do have a question, please put it in the Q&A box, and if you'd like to address it to one of the panel members in particular, that would be great. I think we'll cover the future fund next, if you could skip to that. And Jason, I know we didn't come to you on the valuations point, but I wondered if you had any views on the future fund from perhaps Ori Biotech's point of view, or from your investors. And no problem if you don't, because I think there's plenty of opinions out there among attendees on it as well.
Sure. Yeah, no, I've been, as you might imagine, looking quite closely. I think it's targeted at companies like Ori, who are kind of post their first institutional round, have some good plans, some good traction, but just need a bit of maybe hard to come by capital to continue their growth trajectory. So, you know, the word on the street, you know, from our law firm as of yesterday, you know, the expectation is that the final terms will be really very similar to what they've put out publicly in the terms of the convertible loan note. They don't expect big changes in the structure, which are pretty favorable for the government. You know, if you want to make it better for them, they're happy to have you do that. But otherwise, you take what they're giving you. And I think it's a race. You know, everyone's got to get in as fast as they can with their application, because once the 250 is gone, there's no guarantee of any more being allocated. So that's what I'm hearing in the kind of word on the street.
Thanks, Jason. Russell and Amit, if one of your portfolio companies, or perhaps one of your new investors, was approaching you and looking at this as a matched funding scheme, is this something that you would entertain? Maybe Russell, we can come to you first.
Sure. I mean, I would say that we're sort of neutral. Some of our portfolio companies are looking at it. We don't know all the details yet, which is the problem, to
Very
actually
true.
be definitive on this. And there's also this whole thing about the 8% interest, which is a crazy price if you look at interest rates at the moment.
Yeah.
It's also going to put off certain types of investors. I mean, they don't necessarily want to earn money because it affects their income tax and various other things that has to be declared, and it's a pain. And it also gives the company a cash burn, which they don't probably need. And so I'm not sure that the thinking is quite right around the that element of it. I think you should be very aware that this is not free money.
Yeah.
And there's also the problem of, we've all seen investors who take up a lot of management time by asking for endless reports and stuff. And I don't know what the bureaucracy behind this was going to be, but it could be a real drag on efficiency. I've been on a couple of boards where investors have been the VC arms of public companies, and the level of reporting they've required has been, well, I won't say outrageous, but outrageous. in the sense of, trying to almost like count the bits of paper in your photocopy machine and tell me how many you've got left and all that kind of stuff. Management teams, it's difficult enough to run a company without the bureaucracy of demanding shareholders, and I don't know how demanding they will be as an investor, or if they're just going to let the professional investors run it for them and just hang along. But I'd be surprised if there wasn't some level of reporting, and I think that's a big decision as well. You don't want to be dragged back by investors, and so I'd approach with caution would be my bottom line.
I think that's an excellent point on the reporting and the obligations, and or perhaps additional overhead for investor relations that you've raised, Russell, and I haven't seen that really discussed in any of the reports or analysis on the future fund. Amit, what's I know you're not the specialist in Mobius on the future fund, but it does look like it's been written by a venture capitalist, doesn't it?
It does. Well, I'm not the specialist, but I did email a colleague beforehand just to make sure I was on message with this. I can't see us doing much, if anything, with this as it's currently drafted, because the loan must be matched by a private investor on a pound-for-pound basis. But as it's currently drafted, we as a VCT investor could not provide that capital for a couple of technical reasons. One around the length of the term of the loan, and the other around the redemption premium. So as I understand it, unless there are some changes made, this isn't eligible for or appropriate for EIS or VCT investors, which seems a major flaw in the construction of the fund itself. So as it sits today, unless there's any changes, it's not really relevant to us at all.
Okay, yeah, I think that is an important point. There is detail still to emerge, and both Russell and Amit have touched on this. That it's the EIS and also the VCT compatibility is going to be really, really important, because those tax reliefs for investors are so important to them in investing in early stage businesses. Thank you very much for all your questions. So I think we'll go to take some of the questions from the audience, and please do type them in. I think Mark has asked, anecdotally, is it still the case that raising a few million is easier than a few £100,000 at the moment? So this sounds like it might be a seed stage question. And Russell, do you have an answer for this?
Sure. Well, if it was the seed stage, 200 is very, very small, and more of an angel size check, I would say, or collection of angels. If it was 2 million, it's far too much unless you have 3 companies before that you sold for over $1 billion, in which case we might consider it as a seed round, obviously depending on the traction of the company and everything. The reality is that seed rounds led by institutional investors are going to be between 600 and $1 million, I would say, roughly speaking. Yeah. And a lot of it's to do with what Amit was talking about earlier on in terms of the efficiency of deployment of capital for us. We expect to deploy, as I said before, about 850 million is our average check size, and we want to be get to an ownership position of at least 10% for that. So you can kind of work backwards about what that means, but it would mean it would be pretty hard to get a 2 million round unless, as I say, you've got an amazing track record as an entrepreneur in the past and have had some big exits. In which case, I'm sure you'll. I mean, I do know of an entrepreneur who managed to raise 100 million seed round, but he'd had 2 exits for a lot of money before that. So anything's possible, but for the right people. But for ordinary mortals on their first or second gig, maybe where the first gig didn't work out brilliantly, about $1 million is the kind of aiming the bullseye, I would say.
I hope you're the founder that raised the 100 million seed round didn't suffer from indigestion, or at least he's got a stockpile of Rennies. Amit, perhaps you could take this next question from Warada. What are the sectors which are interesting you at the moment as potential opportunities beyond your portfolio, I suppose?
Yeah, I mean, there's some obvious places that have picked up that are that COVID has brought about that you think could now be interesting if you're taking a generalist approach, whether that's cleaning businesses, mask manufacturing. Some obvious new things have just come about. From I guess a slightly more intelligent answer to that, though, would be that I think that the way we consume has changed fundamentally. So if I look at the online businesses in our portfolio, they both direct consumer businesses. So we are investors in Virgin Wines, for example, a business called Parsley Box that does meals, home meals for the elderly, as well as a business called My Tutor, which is an online tutoring platform. These businesses have all benefited hugely from this change in the way consumers now have to purchase things. So I think we will see that shift even more. So I think businesses that are able to use be it e-commerce or online delivery are clearly interesting, because we only have to look at these business our portfolio to see how well they're performing in this environment. I think that will continue as well. So that is certainly an area we are looking to see what other, be it consumer facing or things can be provided in a slightly different fashion. So looking across at our own portfolio gives us some answers as to where we will be looking at other sectors for that sort of pivot to online.
Thanks, Amit. And Russell, Greg has asked a similar question for you and Kindred Spirit. So the sectors that you're particularly interested in is in the post-COVID-19 landscape?
No, not specifically, and I'll explain why. We're very founder driven. As I said before, we don't have a thesis. We want founders to come to us with ideas rather than trying to project our ideas onto other people. I think there's a negative aspect to that question, in as much as it would be very hard at the moment to invest in certain sectors, specifically travel and hospitality, where they've been decimated. It's one thing to have investments and support your portfolio through these process, but to actually justify to our investors, our LPs, that we're just about to launch in the next best thing in travel when nobody knows if we're going to be able to get in an aeroplane in the next 3 years, would be a very foolhardy thing to do. And there's other sort of middle ground. We passed on a company a while back because they had to basically arrange site visits to factories, and
Okay.
again, really like the team, really like the idea, but you can't. What you have to remember as an entrepreneur is that we've got our investors too, and investing in companies where we know that they're going to be paid to sit around and twiddle their thumbs for the next for however long is going to be make us look questionable in terms of judgment. So we have to think through what it looks like to our investors as well.
Okay, thanks very much, Russell. Greg has asked another question as well, actually, but perhaps Jason, we could bring you in for this one to kick off. What options would you advise to a startup which is pre-revenue, just gone live, but doesn't have a turnover history? All of the government schemes currently seem not to serve the really early stage startups. I mean, I could. I think this is more in reference to the loan schemes. There is actually a government startup loan scheme which has been in place for a number of years, which, Greg, you might want to take a look at. Emanuele can post a link to an information page on that on our website in the chat box. But Jason, beyond that, pre-revenue startups and equity funding?
In this kind of environment, it's tough if you're early. I don't know if you're referring to the bounce back fund or a different one, but apparently there's a kind of small check available with some reasonable terms as a loan from your financial institution. If you're pre-revenue, who knows, it's going to be difficult. What I would suggest is, that stage company has always relied heavily on angels, friends and family, the benefits, the significant benefits of SEIS and EIS for individual investors. I think you have to really, take a deep look at that part of the market and, call your great aunt Millie, who you haven't talked to for a while, and see if you can get her to give you about 20 grand. I think it's, it's really a friends and family focus. The government, I mean, you can tell by my funny accent, I'm an American, although I've lived in London for 10 years. The tax incentives that the UK government has in place around, they basically backstop 85% of an SEIS investment, and 65% of an EIS investment. The risk reward of that is pretty attractive for individual investors. So I think that's probably your sweet spot at the moment. And then, of course, anything to do with non-dilutive funding like Innovate Money, those would be the first ports of call from my perspective. Okay,
thank you, Jason. Andoni has a question for Russell. Given that you can't meet investors in person at the moment, do you have any advice on best practices for pitching remotely?
Yeah, well, unfortunately, video is far from ideal, as we were saying earlier on. But I think that the main difference is that you have to exaggerate your body language slightly, but pretend you're not English, pretend you're Italian or something, would be probably quite a good thing to be doing, with lots of hand gestures and stuff. But no, you have to. But I think the other thing is it's worth in normal times as well as the extreme times, investing in a pitch coach, somebody who's specializes, who can help you through these things. Both in terms of constructing the deck is always useful. It's really hard to do, actually, particularly if you're a nascent business you haven't done it before. You can always find people willing to help, even if it's for free, even if it's somebody who's helped other companies raise money. But then also delivery. It's very difficult for CEOs to do great pitches because you're too close to it, and you're a believer, and therefore it's very difficult to poke holes in your own idea. And having some objective third party sit down, even if it's your mum, but somebody who's done it before, another founder. Most founders are pretty generous with their times to other founders, and you can find people who will give you a healthy dose of reality and objectivity. And that could be in terms of the style that you're presenting with as much as the substance.
Thanks, Russell. I think we'll take, we've got time for 2 more questions, and then I think we'll we'll wrap up. So I've had one question here, Amit, which perhaps you could take. Should entrepreneurs expect material changes in the key term sheet clauses? And they're saying, more investor-friendly terms, perhaps.
I don't expect so. I think we and others were probably operating on the basis of the terms that we felt were appropriate to form business partnerships with people. That's what this end of the market is about. It's about finding founders and management teams that you want to partner with. So whilst I am fairly confident there will be changes around pricing and possible instruments being used, I wouldn't expect there to be changes around the details and the mechanics of how an investor and investee companies operate. So no, I wouldn't expect to see anything around that.
Okay.
Adam, can I weigh in on that, if you don't mind?
Of course you can.
Jason. I think it's an opportunity to be creative. Fred Destin put an interesting article out on LinkedIn about this, and kind of Emmett mentioned the R word, ratchet, and as not something that they're employing, but something that's kind of out there. So I think it's you have to be careful. And to go back to the term question, valuation question. I had an investor say to me that, even if our valuation was a little bit low, management always gets taken care of through an ESOP top up or, incentive-based shares. So if you're not getting the valuation that you hope for, you can potentially try and negotiate, some sort of incentive to claw back some of that equity, just to make sure that the terms can, are palatable for you, and particularly in the early phases.
Okay. Jason, you might want to stay on, because I think you could, this is a seed stage question. So perhaps Russell, I think you've already touched on this, but how much runway should an early stage entrepreneur raise, finding the perfect balance between giving up too much equity and having enough resource to weather today's environment?
You want me to start with that one?
Yeah, if that's okay.
I think Russell's rule of thumb of 18 months seems about right. I think the biggest challenge now is no one really knows how long this sort of COVID dislocation is going to be, causing a risk aversion out there.
Yeah.
And PitchBook put actually really together an interesting report about the impact on VC funding when public markets go down, something called the denominator effect, which I didn't really fully appreciate, which is quite interesting. But I think, you have to be maybe even more conservative. 18 months is a good benchmark, I think, in all times. But I think in 12 months from now, no one really knows what the market's going to be like. So, if you got an 18-month runway, you're out raising at 12 months because it takes 6 months to close the next round. So it's just, maybe a little bit more conservative than you would be in normal times, I guess.
I think we will wrap it up then. I did just see one comment, though, that I would quite like to address. It's not on equity, it's on the government loans. And it was, it's a good question about bounce back loans and C-bills. If you are thinking about either or both of those government schemes, the question was around, is there any more clarity around whether you can apply for a bounce back and then later apply for the C-bills? So we are looking for more clarity on this point, because I've seen it expressed both ways. I've seen lawyers interpreting it as, yes, you will be able to get a bounce back. Then if you need more, you can convert the bounce back loan into C-bills. But also there is a Q&A on the British banking businesses, sorry, the British Business Bank's website saying that you cannot have access to both schemes. So further, the devil is going to be on the detail on that one. Our advice is, if you do need liquidity now, then the bounce back loan is going to be the easiest one to get some money into your account, and you should look at doing that. Finally, I'd just like to thank Russell, Amit, and Jason for joining us on the panel today. As always, we will keep our COVID landing page updated with the very latest news and intelligence that we're hearing from investors, from the banks, etc. And that's at www.ignition.com. .financial/COVID. And equally, if you want to stay up to date with the latest news, we've got our I'm a Founder newsletter, so please do sign up to that, although I know many of you already are. So thank you very much. Have a great bank holiday weekend. And for those of you who get a break from homeschooling, excellent. Bye-bye, everyone.